TheoTrade. This is Don Kaufman. It's August 2nd, 2019, and you are watching the TheoTrade Weekend Update. All right, where to begin? Well, the selling has effectively commenced, all brought on by none other than, well, exactly what we expected, and that was a more hawkish Fed. Now, before we go around and do a little bit of a victory lap on some of the calls from last weekend, listen, this weekend's update, this video portion, I'm actually going to reserve predominantly for a couple of charts and a couple of trade ideas, so I'm going to keep this kind of brief. First of all, we expected the Fed to come out swinging, to be a little bit more hawkish, and that's precisely what they effectively were. Commence the selling, all right? So the sell side activity really starts. Now, thereafter, I can go into the administration, I could talk about some of the retaliation, but the only thing that really matters isn't what just happened in the past. It's what we're looking at moving forward. There's a couple of points that I'm going to make in just a moment here when we get to some of the charts, and one of them is absolutely critical, and that has everything to do with what I term the VIX is still taking a bit of a dirt nap. What I'm trying to say is the VIX is still completely and totally dead. Volatility, you kind of feel like, wow, I just saw almost a 100-point move in the S&Ps, and this guy is telling me, okay, that volatility is still dead? The answer is yes. The volatility, woke up a little bit, but we ain't home yet. We're not home by a long shot. One of the other aspects I'm going to show you here in a moment in the chart has everything to do with historical volatility. It's the annualized standard deviation of past stock price movement, and it's going to show you, once again, you might think this thing is rocking. People, we had 1 week of sell-side activity. What do you expect? We've had buy-side since what? Oh, I don't know, maybe 2009? Nevertheless, you're going to find out real quick that sell-side activity, again, it's just possibly the beginning. And everybody wants that answer. Is this the big one? Well, I'm going to try to answer that for you here in the charts in trades kind of section over there. But moving forward, the last point that I want to make here before we get to those charts and trades is this, the Fed. What's the Fed going to do next? Well, it's very much dependent upon what the marketplace is going to do. The Fed is extraordinarily right now market dependent. Market tanks, the Fed's going to get a little bit more lenient. And some of that was possibly kicked off by the administration. The administration came out swinging again. They went after China with a few more tariffs, or at least the threat thereof. The marketplace is likely to react. One of the big takeaways from this weekend's update, we believe that a lot of the volatility moving forward is the marketplace dictating what it wants the Fed's next move to be. And that is going to cause an extreme amount of volatility in the very near term. The market wants to make it clear to the Fed, I am dangerous, you will feed me with lower rates, you will continue to cut, or I will make you pay. With that, let's get to it. Let's get to some charts and a couple of trade ideas. To the charts and trades we go. Well, let's kind of continue with this theme here. The selling has commenced. There's a couple of bullet points I'm going to follow in this kind of segment where, again, we're going to look at a number of charts, number of trades. One of the first things that I really would like to cover is a bit about the S&Ps, the E-mini S&P futures. You might not trade them, but I'm telling you right now, these things, people, they drive order flow to the remainder of the marketplace. And if you I'm going to zoom in here with me for just a second. I'm going to go ahead and close up this left side bar. These are what we call gravity points. Gravity points have not been in play for quite some time. Nevertheless, they are very much in play after some of the sell side activity that we saw this week. The first gravity point here is 2911. Do not think of this necessarily as support and resistance, but specifically a place that the market is effectively drawn to. It's drawn to it because there's massive positions at these particular levels, okay, from very large derivative and or trading firms. So 2911, 2842 could very well be in play in just the next, well, couple of trading sessions, of course, next week. Enough said on the S&Ps. Listen, I don't want to start, beating the dead horse on sell side activity. Let's now actually break it down into some specifics. One of the first things that I kind of want to mention on our bullets over here is the Apple butterfly. Now, this is something I did a video on throughout the course of the week, was specifically on Apple. I routed a number of trades in Apple. Okay, the bottom line with Apple is that we had a butterfly on Apple positioned bearish. Now, the bearish position butterfly was exclusively because the earnings came out. The earnings, well, the stock moved precisely the wrong direction. It was to the upper end of the expected move. Nevertheless, the butterfly, okay, wasn't good till just Wednesday. Again, the butterfly was placed right before the Apple earnings, which were Tuesday. Wednesday comes out, the stock moves the exact opposite direction by the exact amount, which was $9. Meanwhile, a complete full-fledged reversal led us to what? To a butterfly that absolutely hit pay dirt. Now, we had a butterfly with the central strike of being 200, so it was a 205, 200, 195 fly. We paid in and around 53 cents for it. Most of us were actually to get out of this $1.50 on up to $2, and we actually exited portions of this. So the Apple fly hits pay dirt. We'll continue with our butterflies right and around earnings. All right. But the other aspect that I'd like to be mindful of, so does everything else that's bearish right now. You know, a couple of my bearish positions, and these are all positions that we talked about on these evening videos, live within the TheoTrade chat room. I mean, if you look at some of my positions, one of them might be something like CSX. If I take a look at CSX, okay, it got smoked in earnings, but the follow through this week was nothing less than stupendous. I'm all the way rolled out now to an October position. Continuing on over here, I've also maintained a bearish position inside, well, China. Oh, it wouldn't be fun if we didn't show the Chinese ETF, which got smoked, of course, because of the tariffs, trade war back on. If not looking at the FXI, the EEM, again, you know, there's times in the last couple of weeks I took a lot of heat because I talk about being bearish and I carry bearish deltas. But as I've said time and again, I'm actually not carrying a bearish position. I am not carrying a bearish position in the S&P 500. I'm not carrying in the S&P 500. I'm extraordinarily sector and stock specific. So after you go to China, the EEM, okay, the rails like CSX, well, then I start working in the financials. Take a look at Bank of America. Now, Bank of America was completely unscathed. Now, financials, and I reiterated this in the video portion just a moment ago, but financials, that was my single biggest call last weekend's video was, hey, the financials. Everything that could have ever happened to the financials that was positive has already happened. Therefore, anything moving forward is probably not going to be great. Position inside of Bank of America's duration position all the way rolled out now to November. If Bank of America doesn't work with you, okay, maybe Citi. Now, I've got positions in Citi, Bank of America, JP Morgan. I'm covering kind of the span. I'll talk a little bit more about some of the financials here momentarily, but you have to realize the magnitude of some of these moves. Last but not least, a position that I put on only very, very recently happened to be in none other than Costco. Now, the Costco position is a relatively new duration position. Again, a relatively new duration position where I purchased the 305 puts inside of Costco, which again, okay, it didn't matter who you were. If you were in the right sectors, you were bearish, you hit pay dirt throughout the course of this trading week. Onward and upward. The VIX. Let's talk a little bit about the VIX. Well, this is kind of what I call the VIX. I couldn't come up with a better terminology. Okay. It's still taking a dirt nap. Okay. Effectively what I'm saying, the VIX is still absolutely unequivocally, it's dead, people. So how can you gauge volatility? The point that I'm trying to make with this is you just came off of a fairly wicked week. Now, the specifics of this past week, it's no longer like, you know, prevalent. Like, okay, like the Fed did this and then the administration did this and then the tariffs came out and yada, yada, yada. Doesn't matter. It's all now about statistics in the past, right? And the one thing it's bothersome that we're seeing here in terms of the VIX is, it took off to the upside. It already reverted back down. The other aspect is, as I said, the VIX is kind of just, as I said, taking a dirt nap. It's still rather dead. Okay. Now I've got positions in the VIX and I am positioning long volatility. I sold put spreads to finance the purchase of call spreads. I sold put spreads to purchase the finance of call spreads. The trade, okay, is up. It's up substantially. Okay. But we're not even like, you know, in the money on these 18 calls. So what do? I sit, I wait. Come on, I got 46 more days. Okay, the other way that I really want to talk about gauging volatility is move off the VIX. Okay, that's kind of the predecessor's way of gauging volatility. You want to look a little bit at these volatility futures, and especially on a day-to-day basis. If you guys trade intraday, take a look at the vol futures. We're going to look at the 19-day vol future versus the 47-day vol future. Now, there was a point in time, okay, on Friday's trading session. That's today, that's August 2nd, and Friday's trading session, where the volatility futures, they had flipped. That was short duration volatility had actually exceeded some of the longer duration volatility. Effectively, what that says, the next 19 days would be riskier than the next 47 days, which is, again, kind of some backward thinking. Nevertheless, it's kind of important, right? Because after these vol futures, after they invert, it's a complete and utter free-for-all in the marketplace. Well, those vol futures, they flipped, okay, and then they leveled them right back out. They leveled them literally right back out. But here's also an important point. Look a little bit further out in time. And as we look further out in time, the important point to be taken away is that the volatility futures 47 days, okay, 75 days are identical. And they're slightly above 110 days and slightly above 138 days. There is a slight, people talk about contango and backwardation. Forget it. I call it the volatility futures are inverted, okay? They are slightly inverted in some of the back months. And the back months, believe me, this makes a big difference, okay? The marketplace is screaming to you, I'm dangerous right now. Not necessarily, going to be Mr. Toad's Wild Ride, but it is absolutely unequivocally dangerous out there. The other aspect, I think that's probably worth taking a little bit of time to look at, and I'm going to cruise over to the spiders for this for a second. All right, come over to studies, drop down to study, okay, and come down to volatility studies. Look at historical volatility. All right, historical volatility. One of the things that I just want to point out, this historical volatility is averaged right now, and that's what's on my screen, okay? Right there over the last 20 days, it's picking up, but it's negligible. It's still negligible, right? And again, it's averaged over the last 20 days. So let's tighten it up a little bit. Come over here, edit it, knock it down to like a 5-day historical volatility. And if you're unfamiliar with historical volatility, it's the annualized standard deviation of past stock price movement. People, it just says this. It's how much is this beast really moving? And what I wanted to show you here, okay, is we're moving. Not that much. Not that much. You can see volume spiked, but net, even after we had this monstrous move, I want you to have the feeling, and I want you to watch this and leave with the feeling of like, oh crap, that, look at the historical volatility. It's not that big, okay? So when you're gauging volatility, look at historical volatility. Now you realize why the VIX is probably still taking a little bit of a dirt nap. Now, moving on. The SPX expected move got smoked. It got hammered, okay, in this last week of trade. So as I start to pull up the SPX, let's get to the kind of the long and short of it. Now, with the SPX, right, one of the first things that I beg you to do is, people spend so much time on the charts and so forth, but I beg you, look at the options chain. Look at the options chain, okay? Go out to, for example, next Friday. Get a feel. What does it say? Right? Next Friday, the expected move, right? Right there, right? So coming into to next week, here we have August 9th. Obviously, right now, here we are on August 2nd. So we're exactly 7 days from today. You're looking at about a $58, again, a $58 expected move. Now, that's this next week. And I'm going to come back to that here in a moment, all right? Last week, and you can take a look at last week if you want, but I'll display that to you in a chart. Everybody likes the pretty charts, so I'm going to come into the pretty chart over here, bring up the chart. The expected move last week was, roughly speaking, $38. $38. But where did we really start the week? Well, we started the week right around 3,025. Where did we finish the week? Right here, 29.32. Ooh, that, people, is almost a 100-point move to the downside inside of the SPX. With a $38 expected move, you're almost in 3 deviation territory. Again, almost in 3 standard deviation kind of territory. But the point that I want to make with 3 deviation territory is, okay, you hit statistically significant levels. And that's what everybody starts to pay attention a little bit more. But as I mentioned a moment ago, historical volatility, not necessarily crazy. Let's actually start here in the XLF. And why am I coming to the XLF? If you look at the XLF, I'm going to turn on auto expected moves. Ruh-roh, that is a full-fledged 3 sigma move. Okay, go to individual stocks for just a second. Pull up Amazon. Amazon got rocked. Again, we want to talk about stocks, okay, in terms of statistical significance. This is statistical significance. Amazon got rocked. Forget earnings. Earnings was last week. Okay, it got rocked so far outside of its deviation. This thing started the week at roughly, let's call it 29.43. It was supposed to go down as far as about 29.05. It didn't. It actually fell all the way to 18.23. So think about that week, all right? Over, again, $120 move inside of Amazon just cracks through. That is a full-fledged 3 standard deviation move in one of the biggest market caps that we have. But the point that I'm making with this, it's not just Amazon or it's not just Apple or, okay, don't necessarily go into one sector. I just hit the financials. The financials, 3 sigma move. Amazon, 3 sigma move. Caterpillar, okay? Wild 3 sigma move over here. Shall I continue? All right. Take a look at the technology sector as a whole, and you can actually go into like XLK. XLK got rocked out there. Now, a more disconcerting area when I start talking about 3 sigma moves and large moves, okay, happen to be network appliance. Now, I'm pulling up network appliance. Now, take off the expected moves for a second. This, it's not just about a 3 or 4 or 5 sigma move, okay? This is just alarming on a lot of different levels. Network appliance today came out with earnings. Earnings drove this, okay? Earnings drove this, okay? Or effectively, I should say, and more appropriately, I should say, what drove this was a warning coming into the earnings. I do apologize for that. I'm gonna be quoted on that specifically. But again, this is an underlying that has its hands in a lot of other goods, again, and services in a lot of technology companies. It took with it Cisco. All right. And the reason I'm bringing this up, Cisco does have earnings coming up. But when we're talking about all these 3 sigma type moves, take a look at Cisco again on the network appliance announcement, or should I call it pre-announcement. Again, this is one we're going to keep a very close eye on. It's kind of a fluid situation, but it is extraordinary and damaging to technology, specifically to Cisco. And Cisco obviously is, you know, name almost any major tech company, and they've got some relation back to Cisco. Keep an eye on the situation. Again, I kind of call that the 3 sigma moves. Let's move on from there. So again, we saw the SPX get smoked, 3 deviation. Expected move for next week is a rocket. Is it time to sell? Now, that means we need to go back over to the SPX. So back over to the SPX, and I said the expected move is a rock. And what is the expected move? Once again, the expected move is right around $58, okay, and change. So last week, the expected move is $38. This next week, you're looking at a $58 expected move. And the question immediately is, do I sell premium? Okay. Now, if you remember from just a moment ago, when I was talking about the VIX is still taking a dirt nap, my answer would be unequivocally no. If you have premium to sell against existing positions, when I talk about existing positions, okay, this is another one we're going to bring up here momentarily. I have a position in Boeing, a bearish position in Boeing, okay, and I'm 49 days out. I could sell some short duration premium against my Boeing position. You know, I mentioned a moment ago, I was in a position in CSX. Okay, and CSX has been just hammered lately. Okay, great. I could come to CSX because I own a position 77 days out. Okay, and again, I could sell some shorter duration premium against that. I am fine with that. It's for those of you that are trying to construct things like iron condors. Okay, if you're looking at the idea of an iron condor, listen, volatility, all right? Yeah, come on. We saw what happened. Again, the SPX kind of got smoked in here. The expected move is a rock and it's up to $58. Everybody, all the premium sellers are going to come out. All right. We could be on the verge of a bigger move. You know, this is something where the moment there's sell side activity, everybody comes out of the woodwork. They're sellers. Okay. Duck and cover. Listen, I don't know if this is going to be the big one or not. I mean, this is like living in California. Is it the big one? And every time the earth starts shaking, everybody thinks it's the big one. You don't know. All you can do is go with the statistics. And I got to tell you right now, okay, we cracked this far outside of the standard deviation. Okay, almost 3 deviations. And the way I look at it, you're getting paid crap. $58? What are you kidding me? $58? I just saw us move, okay, 100, and you're only going to pay me for $58? Not my money. I'm not going to be selling premium over here. I hope that answers the question. Time to sell premium? Not for Don. Now, let's continue. Onward and upward. Damage has been inflicted, okay, to the market, but several crushed stocks are showing signs of life. What am I actually talking about? Oh, here's where we actually get overbought, oversold, right? On a day, the marketplace ends up the week down like it did, but specifically on a day where the S&Ps are down 19. Check this out. The Nasdaq lost 1.3%. There are a few stocks that are actually showing signs of life. One of those, I just brought up a moment ago, is Boeing. But if you look at like Boeing on a year-to-date percentage, and I think that this is really worthwhile to do, kind of a good exercise, just in the last, couple of trading sessions, just wait for it, you're like 2 weeks, it was up 17%, okay? And that little monkey was almost flat on the year. It had a bounce, okay? This actually could be the beginning of a much larger bounce inside of Boeing, or at least a little bit of a relief bounce. Listen, markets, you can call them oversold to a degree, okay? But there's a couple of stocks that have really, really been hammered. What else do I have besides Boeing? Walmart. Walmart has been really hammered on hard, okay, the last 3 weeks of trade. This is one where we had a bearish position. We closed it fully profitable. That was actually a big surprise position that was not working. Closed that Walmart position. Walmart, that's 3 weeks of trade, people. This thing was up 23%. It's now only up 17%. That is a possibility of a hideously oversold kind of condition. Last but not least on that front, and I could go all day long on here, the damage that was inflicted was so severe to the financials, they actually rallied a little bit in, again, towards the end of the week. In fact, the XLF, if you look on an intraday basis, is going to close massively unchanged. It doesn't mean that there can't be more sell-side activity. But if you start to look at this from a risk-reward, this is not, again, the point that I want to make is specifically with the XLF, people look at this like, oh, the sky is falling. Yeah, this is not the time to bear up. The time to bear up was up here. Okay, you don't get bearish, you don't short into that hole. Why? Because that hole is very likely to pop right in your face. Keep that in mind. Damage is inflicted. Again, there are several crushed sectors, several crushed, okay, stocks that are showing a few signs of life. You know, I can make that argument as looking down the list of some of the usual suspects. I could probably make that argument about a number of stocks, including like Tesla, okay, which has actually bounced back up, felt some pain, ripping a little bit again, but they're few and far between. Now, continuing onward from here, the death of interest rates. Yes, this week actually marked the death of interest rates. You remember interest rates? You'll be talking about this 10 years from now. You remember interest rates? Yes, that is when they actually paid you. It was nice to be paid on your money while it lasted. The death of interest rates has nothing to do with, well, the last 9 months is fairly spectacular, right? Okay, it's an interesting ride to the downside. But hey, have no fear. Open that up. Open it up to what? Well, in this case, we're going to go maximum chart. I don't know about you, but I've mentioned this before. I am starting to see a little bit of a trend here. The death of interest rates is really, it's upon us. The TNX, the 10-year, okay, is just bidless here. I mean, the interest rate is collapsing. That's the 10-year. It's 1.8. If you take a look at the bonds have gone absolutely parabolic. What I'm going to be doing this next week, I'm actually going to shift. I have ratio back spreads in here. The ratio back spreads didn't cost me anything. They were done for a credit. So I'm going to take those, I'm going to close them, and then I'm going to shift those ratio back spreads closer to the money. Think about it. If you have no idea what I'm talking about, don't worry. On Monday, I'm actually going to show you live in the TheoTrade chat room. So death of interest rates. And that actually leads us to the final point that I want to make in this weekend's update. The search for yield is on. Forget business models. Seriously, forget business models. If they pay a dividend, okay, buy it. Now, why do I say that? I don't know. Take a look at Verizon. Okay, take a look at Verizon. Because if you looked at Verizon and looked at the earnings, like, we hate you. We don't like you at all, Verizon. I mean, if you look at the last, couple of hours of trade, last 24 hours of trade, we hate you until we realize that the yield is going to be zero, and then we love you. Look at Verizon, 4.3% dividend yield over here. Okay, now there's a bigger point to be made. Look at AT&T. AT&T, like, oh, come on, Ma Bell. Nobody's liked Ma Bell in 30 years, people, and they're loving it. They're absolutely loving it. Forget earnings. Earnings hangover. The earnings were over a week ago. Okay. They love it. And to continue on that theme, you would have to look at the utilities. Now, the utilities ended up flat on the day. I do actually carry a position in the utilities. They like me. They really, really like me. Why? Because you pay a 3.2% dividend. The point that I'm making with this is not that you should run out and buy utilities, is not that you should run out and buy Verizon. The point that I want to make with this, these are actually construed as low beta products. What's low beta? It's supposed to be low risk versus the S&P. If the S&P moves 1% and the beta here is 0.5, this product's supposed to move half as much as the S&P 500, okay, on a percent for percent basis. It isn't doing that, okay? If you think that you're in low beta stocks, okay, newsflash, you're not. Dividend yielding products are going to carry rather extreme volatility moving forward. Dividend yielding products are going to carry extreme volatility. Yeah, we ain't in Disneyland anymore. This marketplace, okay, forget for a second that selling has just commenced. The yield is effectively heading down to zero. And when you get squeezed, okay, that search for yield is on. This is when trading firms, this is when retail clients, this is when anybody that has money starts to do very stupid things in search for yield. Opportunity is starting to really open up in this marketplace. Expect, okay, more volatility in the days and weeks to follow. Thanks everybody for joining us here at TheoTrade. Have a wonderful weekend. Bye-bye.